The commercial real estate industry is in a Category 5 hurricane from the Federal Reserve's interest rate hikes, according to billionaire investor Barry Sternlicht. The problems in the commercial real estate industry are getting worse, and a wealthy real estate investor is warning about it. They're closely watching the chain of loan defaults, but on the bright side, there will be a significant opportunity for profit. Barry Sternlicht, a billionaire, occupies the positions of co-founder, chairman, and CEO at Starwood Capital Group, an investment fund overseeing assets exceeding $120 billion in value. Starwood Capital stands as one of the globe's premier real estate corporations, and Sternlicht's role as CEO gives him invaluable perspectives into the intricacies of the real estate market. I like to say it's a hurricane over real estate right now. We're at the Category 5 hurricane, and it is sort of a blackout hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term. One of the world's most successful and respected real estate investors is sounding alarm bells of the hurricane brewing in the real estate market. In a recent interview, he discussed a metaphorical Category 5 hurricane that looms on the horizon, poised to impact the real estate market in the coming months. The economic hurricane headed our way. Namely, trillions of dollars of low-cost corporate debt are maturing over the next 3 years that will have to be refinanced at today's significantly higher interest rates. This will cause enormous financial pain. Legendary investor Warren Buffett once quipped, "You only find out who is swimming naked when the tide goes out." Well, with the Fed nearly certain to raise rates to 5.25% to 5.5% last week and hold them there, and $1.4 trillion in commercial real estate debt coming due by the end of next year, the tide is going out. And no sector has more naked swimmers than commercial real estate. Investing in real estate revolves heavily around the concept of yield, which can be significantly influenced by fluctuations in interest rates. Essentially, when you put your money into real estate, you're aiming to achieve a return on your investment, just like you would with other types of assets. This return typically comes from rental income and the potential increase in property value over time. Imagine you have a collection of rental properties, each of them consistently generating rental income. This income can be likened to the dividends you receive from stocks or bonds and is a fundamental aspect of your investment. However, when interest rates go up or down, it can have an impact on both the current and future value of these income-producing assets. Here's how it works. To determine the current worth of your real estate portfolio, you need to consider the net rental income it generates. This involves accounting for expenses such as property management, maintenance, property taxes, and more. The higher the interest rates, the less your future rental income is worth today due to the concept of time value of money. The capitalization rate, or cap rate, is an important metric in real estate. It represents the annual return an investor can expect to earn on an income-producing property. When interest rates rise, investors often demand a higher return on their investments to compensate for the increased risk or the opportunity cost of putting their money elsewhere. Consequently, cap rates tend to increase in a rising interest rate environment. Let's see the impact of interest rates on your real estate portfolio's value. Suppose you own a diverse portfolio of income-generating properties with an estimated net rental income of $500,000 per year. If you discount this income stream at a 5% interest rate, the portfolio's value today would be approximately $10 million. However, if interest rates were to increase to 7%, the value of your portfolio would decrease to approximately $7.1 million. This decrease occurs because the future income generated by your properties is worth less in today's dollars due to the higher discount rate. Moreover, in response to higher interest rates, cap rates in the market might also increase, further impacting your portfolio's value. A rise in cap rates can lead to a considerable decline in property values. Therefore, while the fundamentals of your real estate investments, such as rental income, remain stable, fluctuations in interest rates can greatly influence the perceived value of your portfolio. It's a complex dynamic where investor sentiment and economic conditions play a big role in shaping the real estate market's landscape. The surge in interest rates and the emergence of remote work have joined forces to craft a troubling situation for investors in commercial real estate. Sternlicht oversees a substantial $115 billion real estate investment portfolio. Sternlicht is famous for his vocal criticism of the Federal Reserve's assertive interest rate increases in the preceding year, proposed that his industry has fallen prey to the central bank's attempt to rein in inflation. He shared his perspective on the potential magnitude of the hurricane's impact, leaving it somewhat uncertain whether he was delivering his assessment in a jesting manner. Starwood Capital is a major player in both residential and commercial real estate on a global scale. However, in the past year, the company has been going through many challenges. It has had to deal with demands from investors looking to withdraw their investments from certain non-public funds. Additionally, just this month, Starwood experienced a default situation when it failed to meet the obligations on a $212.5 million mortgage for an office tower located in Atlanta. Sternlicht made it clear that his company isn't the only one facing these challenges. He pointed out that many office property owners are feeling the pain due to the significant number of empty office spaces. Starwood's fellow big players in the corporate real estate world, like BlackRock and Brookfield Asset Management, have even decided to stop paying for some of their office properties that have a lot of vacant space. This move reflects the impact of the remote work trend on the demand for office space, and it's not just affecting Starwood, but the industry as a whole. Sternlicht made an argument that the office sector is on the verge of a significant divide between those who thrive and those who struggle in the years ahead. He suggests that quite a few of the have-nots might even face the risk of going out of business due to the challenges in the evolving office landscape. The nice buildings will stay rented, and my guess is at pretty good rates. And the B and C stuff is going to be maybe fields of grain or something. It'll be very pretty. Well, all these little mid-block parks in New York City because there won't be anything else to do with those buildings, he said. It's not just Sternlicht who is worried about commercial real estate and the future of offices. Morgan Stanley has warned that the ongoing CRE crash could be worse for the sector than what was seen during the global financial crisis of 2008. And Capital Economics thinks the CRE nightmare is going to be so dark that office values won't recover until 2040. To their point, the amount of distressed office real estate assets shot up 36% in the second quarter to $24.8 billion, according to Amidst Real Assets, the first time since 2018 that hotels or retail didn't take the top spot for most distressed. And with an estimated $1.4 trillion in commercial real estate debt coming due by the end of 2024, some CRE execs have warned an apocalyptic downturn is coming as borrowers are forced to refinance amid higher interest rates. Sternlicht is giving us a heads up. He's saying that if the commercial real estate world keeps struggling and interest rates keep going up, it could lead to more regional banks failing, just like what happened in March with banks like Silicon Valley Bank and Signature Bank. When consumers start worrying that their money isn't secure in regional banks with connections to commercial real estate, they tend to shift to bigger, more stable banks. This can put pressure on smaller banks, leading them to stop lending for commercial real estate and demand repayment on their existing loans to strengthen their financial standing. As a result, those borrowing for commercial real estate have to sell their properties in a market that's not doing well, which speeds up the ongoing economic downturn. All this uncertainty can further prompt people to withdraw their deposits from banks, potentially causing even more bank failures. In this troublesome situation, Sternlicht issued a warning that as many as 400 or 500 banks could potentially face failure. When faced with adversity, you've got to find a way to turn it into an opportunity, just like Barry Sternlicht has done throughout his career. Sternlicht, who is now 62 years old, managed to build a multi-billion-dollar empire by taking a calculated risk during the savings and loan or S&L crisis of the 1980s, which led to the downfall of hundreds of banks across the country. In 1991, he founded Starwood Capital Group with a mission to purchase apartment buildings from the Resolution Trust Corporation. This government entity was created to sell off the assets of the banks that had failed during the S&L crisis. Sternlicht's ability to seize opportunities in challenging times has been a key factor in his success. So, in a remarkable turn of events, a mere 18 months later, the values of those apartment properties skyrocketed. Seizing the moment, Sternlicht sold the entire portfolio to the late billionaire Sam Zell's Equity Residential. In exchange, he secured a 20% stake in Zell's company. Now, Sternlicht envisions a scenario where more banks face failure, potentially leading to the creation of a second RTC, similar to the entity formed during the S&L crisis. This prospect excites him because it could allow him to relive his early days when, at the age of 31, he founded Starwood Capital. In such a situation, he sees the opportunity to purchase distressed assets at discounted prices from these failed banks. Sternlicht believes that these banks will be compelled to sell, presenting what he considers a remarkable opportunity in the making. Only time will tell how accurate Sternlicht's predictions are, but his comments are a reminder that the commercial real estate industry is facing some significant challenges. Investors who are considering investing in this sector should carefully weigh the risks and rewards before making a decision. The future of commercial real estate is uncertain. However, investors who are willing to take calculated risks could potentially profit from the opportunities that this sector may offer. If you found this information valuable and enjoyed this content, please consider giving it a thumbs up or hitting the subscribe button.